Janet Yellen and the United States Treasury Department have been getting slammed on the internet lately. Why? Because a billionaire investor by the name of Stanley Druckenmiller came out publicly and said that our Treasury Department made the biggest blunder in US history. What is this blunder that he's talking about? Well, a few years ago, when we were in the pandemic and interest rates were near zero, our Treasury Department was issuing a lot of loans, aka the government was borrowing a lot of money. But the problem is that he was talking about is that our United States government was issuing short-term loans, things like 2-year loans and 5-year loans that are now readjusting at much higher interest rates, when what he said is that the government should have been issuing 10-year to 30-year loans. That way the government could actually benefit from the low interest rates for a longer period of time. Now here we are today, and the government is being forced to pay out much higher interest rates because all these short-term loans are coming due. And the reason why this is so significant today is because just recently the Treasury Department came out and said that they need to borrow an additional $776 billion to finance the government spending for the fourth quarter of 2023. So what I want to do in this video is go over what is the impact of these low interest rate loans that are now coming due. Why does the government need to borrow so much more money? And what does this mean for you? And if you stick with me until the end of this video, I'm going to show you how you can get a copy of this ebook, How to Build Wealth as an Investor by Briefs Media, for free. So starting with this quote unquote biggest blunder by the Treasury Department. By the way, if you want to read the article for yourself, I'll link it for you down in the description. But what Stanley Druckenmiller says is that, quote, when rates were practically zero, every Tom, Dick, and Harry in the United States refinanced their mortgage and every corporation was extending their debt. AKA, you had a lot of people, businesses and people that were refinancing and pulling out money at ideally longer-term interest rate loans, because when you were getting these 2 or 3% mortgages, it was an opportunity for you to borrow money and lock in that loan for a longer period of time. And you saw a lot of people do that. But what the United States government did was they were taking out a lot of debt. We were borrowing a ton of money. We were also spending a ton of money, more money than really ever before. But we were doing it at these short-term loans. And now today the issue is a lot of these loans are starting to come due. We're going to see more loans come due next year, and we're going to see even more loans or United States debt come due the year after that. And if interest rates continue to stay high, that means the government is going to have to pay out much more money in interest. Now, how does the government generate this money? Well, either through taxpayers and tax dollars or by borrowing more money. So either they can raise your taxes or they're going to have to borrow more money to pay back their previous debts. Now you can start to see why that's a problem, because at the end of the day, the government needs to pay back everything, right? They have to pay for their expenses somehow. They can't just keep infinitely printing money out of thin air, because that would eventually lead to hyperinflation, which means they have to generate money through taxes. Now, where do they generate their taxes from? They generate their taxes from people like you and me and investors and business owners and employees. If you make money, you got to pay money in taxes. And so now when you're running into a situation where government spending is not slowing down, in fact, this fourth quarter borrowing by the United States government, the $776 billion that they're borrowing, this is less than what was originally expected, but it is the most amount of money borrowed by our government in the fourth quarter ever. And in addition to that, the Treasury Department also announced that they want to borrow an additional $816 billion for the first quarter of 2024. That would also be a record borrowing amount for the first quarter of a year. So the government is still spending a lot of money. They're spending more money than what they're bringing in, which is why they have to keep borrowing more money. But this money has to be paid back somehow. How do they pay this money back? Through taxpayers and tax dollars. Now, in addition to paying this money back, they have to pay it back plus interest. Now, the government has to pay interest just like everybody else. And the interest rates are set through what is called Treasury yields. And as the Federal Reserve Bank has been raising interest rates, the yields on these treasuries, meaning the interest rates that the government has to pay back, are also going up. So now the government keeps borrowing more and more dollars. If you have to pay more interest rates or higher interest rates to borrow these dollars, that means you have to pay more money back plus interest. So that means the government's expenses are rising, not just because they're spending more money, which they are doing, but also because their interest payments are also rising. So if the government has this double whammy, they're spending more money and they have to pay more money in interest, they're gonna need a lot more tax dollars. How do you generate more tax dollars? Well, there's two ways you can go about that. Number one is you can see growth in the economy. And if you see growth in the economy, more people have jobs, people have more raises, people have more taxable income, the government gets more money. Option number two is that the government raises your taxes. Now, what we've been seeing up until now is that we've been seeing economic growth. We've been seeing a lot of booming profits. People have still been getting raises, but the trend is kind of going a little bit downwards. In fact, what we've been seeing for over 12 months now is that wage growth has slowly been going downwards. I just made a video about this last week. Wage growth is shrinking. In fact, the most recent data by ADP, the payroll provider, said that wage growth is now falling by the lowest numbers we have seen since almost the beginning of the pandemic. So wage growth is slowing. We're seeing hiring slow. We're seeing spending start to slow a little bit, although spending is still strong. However, people are going broke. Even Jamie Dimon, the CEO of JP Morgan Chase Bank, went out publicly and talked about this last week, where what he was saying was, we're seeing more and more of your middle of the ground Americans, your lower income Americans, your middle income Americans run out of money. Yeah, the wealthier people, the richer people, the higher income people, they're doing okay. But the average person is starting to a lot more struggle with money. And so if we go into a time, let's start talking about hypotheticals. If we go into a time where the economy is slowing, that means people stop making as much money. People lose their jobs. That means businesses make less profits. If businesses make less profits and people have less jobs, there's less taxable income for the government, which means the government will be generating less tax dollars. If the government is generating less tax dollars during a time where they have higher expenses, that means they're going to need to finance more spending. If you have to finance more spending, meaning you have to finance paying back your debt, that means you're printing money to pay off your printed money in the first place. You have to print money to pay back the money that you printed in the first place. You can start to see where that poses an issue. And so now, this is where a lot of people are starting to see concerns about this. One of the things you've been seeing happen is that Treasury yields, the interest rates on these treasuries, the loans to the government, have been rising over the last number of months. Now, some of that has to do with the Federal Reserve Bank raising interest rates. Some of that has to do with worries about inflation. Some of that has to do with worries about the economy. But at the end of the day, if you're worried about an investment, you're going to naturally want a higher return. And if people are getting more worried about the health of the economy, about the Treasury Department's ability to pay these things, they're naturally going to want a higher return, which is why you're seeing higher rates by treasuries, meaning the government has to pay out higher interest rates on their loans. Now, if you're the one getting interest from the government, that's good, you're getting higher interest rates. But if you are the government and you got to pay out higher interest rates, that's a problem. And this is where now people are forecasting out the next 5 years, 10 years, and 20 years. If we stay on this trajectory, we're going to be paying out a big chunk of interest that it will make up a huge chunk of our GDP. If you look at the entire GDP, a big chunk of our entire GDP will just be paying back our own interest. That's a problem. And so the question is, how long can the government sustain this type of spending? And if the government were to cut back on their spending, what would that do? Because that is painful. Now, it might seem like common sense. We need to cut back on spending, but what does that actually mean in actuality? Because if the government were to cut back on spending, that means construction workers would lose their jobs. That means some defense companies might go out of business. That means some government jobs might go out of business. That also could mean that some entitlements could go down. That could mean you stop receiving some social security benefits. That could mean some welfare benefits go down. That could mean some insurance benefits go down. All these things are painful, and we as a society have become so entrusting that the government will take care of us. But if the government starts running into more and more financial problems, you would have to think that they might have to cut back on some of their entitlements. They might have to cut back on some of their spending. And that could be bad for the economy, and that could also be bad for consumers. And this is where now understanding there are issues brewing behind the scenes. And this is where I want you to be more financially educated and understand what's happening, because while nothing happens overnight. I want you to understand the different things that are happening at play. That way you can start preparing yourself and start building your financial education and your financial preparedness, because at the end of the day, all these things also create opportunities. But they only create opportunities for those who are financially educated and for those who are prepared. Now, when it comes to financial education, this ebook can help you with that. It's a very comprehensive ebook going over things like the mindset that you need to become a successful investor, to how do you save your first couple $1,000s, to how do you start investing, different ways that you can invest, to how do you spend your money, to how do you earn more money, to how do you protect your assets. There's a ton of value in this ebook. If you want to get a copy of this ebook for free, all you got to do is click the link down in the description below, or go to briefs.co/ebook. But this is where you also want to work on building that financial preparedness, meaning stop spending all your money, put some cash aside to protect you, and put some cash aside to be able to capitalize on opportunities that might come your way. Because you can have all the financial education in the world, but if you see something, you see an opportunity, but you have no money to capitalize on it, you can't do anything. That's why I keep saying 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to build that financial preparedness. It's for you to get financially smart and to build that financial education. That way, if we continue to see more economic issues in 2024 and 2025, you will have the ability to capitalize on them and come out a winner while everybody else gets financially hurt. And that's why I want you to be aware of what's happening and be educated and make sure that you can take care of yourself.